It didn't start in the ports. It started in the banks. Overnight, China switched its trade settlements out of the dollar. In less than 12 hours, $42 billion in U.S.-bound payments disappeared from the global clearing system. American importers woke up to empty ledgers, ships mid-route with no cleared invoices, and lenders refusing credit. Washington called it technical disruption. Beijing called it normalization. Everyone else called it what it was, the moment the world stopped waiting on the U.S. dollar. 3 weeks earlier, Washington introduced a sweeping maritime tariff, a $3 billion levy targeting ships built, owned, or operated by Chinese firms. According to Bloomberg data from October 2025, the measure aimed to reduce Beijing's control over global shipping by penalizing its vessels in U.S. waters. Yet within 48 hours, the plan backfired spectacularly. Because Chinese shipbuilders dominate the industry, owning or constructing nearly 45% of the world's cargo fleet, the tariff didn't just strike China. It crippled supply lines that touch nearly every American importer. Reuters reports that by the end of September, total U.S. container imports had fallen 8.4% year-on-year, with shipments from China plunging almost 23%. West Coast ports, the arteries of America's trade with Asia, took the hardest hit. Los Angeles and Long Beach saw Chinese imports collapse 31.6% in a single month. Warehouse space that was once scarce now echoes with emptiness. The new rule meant every Chinese-linked vessel required additional documentation, insurance clearance, and verification checks, a bureaucratic maze that turned a one-day turnaround into a week-long delay. Inside the White House, officials argued the slowdown was temporary, but the markets told another story. Freight rates between Shanghai and Los Angeles dropped 14% in a single week as carriers began to reroute. Bloomberg intelligence noted that one-third of vessels serving U.S. ports were suddenly ineligible for entry without paying extraordinary fees. The shock rippled across global insurance markets, pushing maritime coverage costs up 28%. China didn't retaliate publicly. It pivoted. Instead of contesting Washington's move at the WTO, Beijing quietly ordered its shipping conglomerates to divert cargo to alternative destinations. Within days, container routes were redrawn. Goods once bound for California began docking in Rotterdam, Felixstowe, and Piraeus. Reuters tracking data shows Chinese exports to the European Union surged 12%, while exports to the U.S. fell nearly 9%. Britain's port of Felixstowe reported a 30% spike in container traffic, the sharpest increase in its history. This shift wasn't improvisation, it was execution. For years, Beijing had built redundant port access through its Belt and Road Initiative in Greece, Sri Lanka, Pakistan, and Kenya, enabling trade rerouting in real time. When the U.S. raised barriers, China opened side doors. By October, shipping monitors recorded 117 blank sailings, canceled routes, between China and the U.S., representing nearly 10% of total trans-Pacific capacity. The damage at home became visible fast. The Port of Los Angeles lost more than a third of its scheduled arrivals. Long Beach terminals cut shifts. According to the Pacific Maritime Association, nearly 15,000 longshore jobs are now at risk. Those aren't numbers on a spreadsheet. They are paychecks in limbo. Each vessel that skips an American port leaves behind empty shifts for truckers, dispatchers, and warehouse clerks. The ripple effect extends far inland, into grocery prices, factory inventories, and retail shelves. Economically, the blow struck deeper than anticipated. The Wall Street Journal reports that large U.S. importers, from electronics to furniture, now face transit delays of 4 to 6 weeks. Many are resorting to air freight at up to 7 times the cost to maintain inventory. For small businesses, the math no longer works. Margins vanish before goods even reach the docks. Then came Beijing's second move. On October 10th, China's Ministry of Commerce announced new export licensing for lithium battery components and rare earth materials. These are just critical inputs for electric vehicles, smartphones, and defense systems. Reuters confirmed the controls will take effect November 8th, effectively throttling supply to any nation seen as hostile to stable trade. Overnight, shares in U.S. EV manufacturers slid 9%. The Financial Times described it as supply chain retaliation through precision leverage. Let's pause, because this wasn't supposed to happen. The tariffs were designed as pressure, not provocation. But by targeting China's maritime dominance, Washington struck the one sector where Beijing holds irreplaceable leverage. According to the Wilson Center, China's shipyards produce over 40% of global commercial tonnage, compared to barely 1% for the United States. Beijing can replace lost routes faster than America can build new ships. Meanwhile, Chinese state-backed logistics systems, including the Logink digital platform, coordinate real-time data across dozens of partner ports in Asia and Europe. This gives Beijing visibility over global cargo flows, an advantage Washington can neither access nor disrupt. As a result, when the US moved, China already knew how to reroute the board. Back in Washington, Treasury officials faced an uncomfortable realization tariff revenue was climbing, but cargo wasn't. According to the U.S. Census Bureau, import volumes from China dropped 27% in August alone, contributing to a $21 billion contraction in trade activity. That contraction translated directly into lost tax revenue, slower retail turnover, and declining port fees. America's attempt to weaken China's shipping empire instead weakened its own logistics backbone. The Financial Times highlighted another irony. The beneficiaries of the chaos weren't American manufacturers, but European intermediaries. As goods bypassed U.S. ports, European logistics firms signed new long-term contracts with Chinese exporters. Lloyd's List reports that the port of Rotterdam has reached record capacity, handling 4.3 million TEUs last quarter, a 19% increase over 2024. In global trade, every blockade becomes an opportunity for someone else. The U.S. Chamber of Commerce, typically supportive of tariff enforcement, issued an unusually sharp statement on October 12th, warning that policy-induced inefficiencies are eroding supply resilience faster than adversarial pressure. That's diplomatic language for self-inflicted damage. In China, the contrast is striking. Manufacturing output rose 8.3% in August 2025, even as United States-bound exports fell 27%. The void was filled by Southeast Asia and Latin America. Exports to ASEAN nations jumped 15.6%, to Latin America 15%, to Africa a staggering 56%. Beijing's diversification strategy, once theoretical, is now functioning policy. Economist Zhang Yanxing, an advisor to China's National Development and Reform Commission, told Reuters that every United States restriction becomes a new corridor for us to open. It isn't rhetoric, it's logistics math. Inside the United States, that math looks brutal. A study by the Descartes data mine shows East and Gulf Coast ports now handle 44.5% of total container imports, up from 38% in April, a migration driven by West Coast paralysis. Yet even these gains mask a deeper weakness. The United States doesn't have enough ships, dock workers, or inland rail flexibility to absorb diverted traffic. Containers pile up in Savannah, Norfolk, and Houston with nowhere to go. Bloomberg Economics estimates that port congestion is shaving roughly 0.4% off quarterly GDP growth. For an economy already grappling with inflation and rate pressure, that's a direct hit. Yet even amid crisis, there's calculation. Airbus is expanding its Alabama plant while simultaneously increasing assembly capacity in Tianjin. By producing on both sides of the tariff wall, it avoids penalties and secures market access. It's a case study in adaptive capitalism, playing both superpowers at once. The pattern exposes a deeper split inside the West itself. While Washington hardens its trade stance, European governments are quietly integrating with China's redirected flows. French, German, and Italian firms are ramping up orders through Belt and Road logistics hubs. The Wall Street Journal notes that European Union importers have replaced roughly 18% of their United States sourcing with direct Chinese contracts since mid-summer. The Transatlantic Economic Alliance that once stood united on trade strategy is starting to diverge. This fragmentation is not ideological, it's structural. Europe depends on physical access to goods. America is relying on enforcement to reshape them. One prioritizes flow, the other control. The question is which approach sustains prosperity longer. Meanwhile, the human cost grows. In Long Beach, shift supervisors describe a surreal calm. Cranes idle, coffee shops empty, parking lots half full. A dock worker tells Bloomberg he's working 2 days a week instead of 6. These are skilled union jobs with average annual wages above $90,000. Their loss radiates outward. Fewer shifts mean fewer deliveries, less spending, and more local businesses folding. At the same time, trucking firms that once serviced ports are going bankrupt. The American Trucking Associations estimate over 8,000 independent operators have suspended operations since August. Diesel demand on the West Coast is down 11%. Economic damage is spreading beyond coastal boundaries into the heartland. The United States government faces a policy paradox. To sustain port jobs, it must attract ships. To attract ships, it must ease tariffs. To ease tariffs, it risks appearing weak. Each option triggers its own backlash. The trade war has become a logistics war, and wars of logistics are never won quickly. According to IMF trade models released in September, a prolonged dual tariff environment could slice 0.8% off United States GDP growth by mid-2026 while boosting China's share of global exports to 17%, its highest ever. Those numbers challenge the assumption that economic confrontation equals dominance. Sometimes resilience looks like retreat. Behind closed doors, Treasury Secretary Scott Bessent is reportedly pushing for a recalibration. Not a reversal, but a strategic pause. Sources quoted by the Financial Times say Bessent argues that industrial renewal cannot begin while maritime throughput collapses. The statement isn't ideological, it's mathematical. No volume, no growth. But momentum is hard to stop once it's political. The administration's tariff policy polls well domestically, framed as defending American industry against Chinese manipulation. Yet, beneath the rhetoric lies the logistical contradiction. Without functioning ports, no protectionist measure can achieve its intent. The deeper question is structural. America's dependence on foreign-built ships, nearly 99% of commercial tonnage, leaves it strategically vulnerable. The Wilson Center warns that, Washington's maritime blind spot is as much about shipyards as it is about sovereignty. The last major U.S. shipyard capable of large-scale container production closed decades ago. And even if Congress allocated funds tomorrow, rebuilding that capacity would take years. The global system, meanwhile, is adjusting around that gap. Freight analytics from Queen plus Nagel show that while total United States imports in early 2025 rose 3.6%, Chinese origin cargo fell 5%, replaced by intermediary exports from Vietnam and Malaysia, countries whose own inputs still rely on Chinese materials. Decoupling, it seems, is occurring more in labeling than in substance. The implications stretch beyond trade. When Chinese port data shifts to European terminals, it alters currency flows, energy routes, and shipping insurance networks. It's not merely cargo moving, it's influence. So what happens next? Models by the Complexity Science Hub in Vienna predict that if the United States suspends tariffs for 90 days, inbound shipping could surge 150% as backlogged vessels flood the system. Long Beach would face a 73% spike in arrivals, Oakland 61%, Tacoma 56%. That rebound, while temporary, could break ports already stretched thin. Relief and overload now mean the same thing. And if tariffs continue, the bleed persists. Slower, quieter, but equally destructive. The geopolitical balance is shifting in real time. China is turning constraint into leverage, Europe is turning opportunity into partnership, and the United States is learning the cost of unilateral power in an interdependent world. The docks remain silent tonight. The cranes are still. The Pacific horizon glows faintly under sodium light, a mirror of economic ambition meeting logistical paralysis. And in that stillness, a single question lingers. When the world's cargo no longer needs to dock in America, what does American power weigh? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.